Okay, great. Thank you, David, for having me. These are always a lot of fun to do, and I enjoy listening to all the other presenters too when I have time. So we're going to go ahead and cover a lot of ground today. We have a lot of material to cover, so I may go fast at times, but don't worry because a lot of the slides are just images and we don't have to read every word. But we're going to talk about how to simplify your options trading. We have some unique proprietary automation technology and software solution for you. So we're going to look at pre-built option spreads, automation for risk and profit controls. We can use strategies for any market environment, and we're going to look at the most unique trade alert functionality you've ever seen. At least that's what people have told us. I've never seen anything like it. But before we get started, let's keep everything in context here. We are trading, which means we're trying to make money, but with reward, there is always risk when you speculate. So do take a moment to read the risk disclosure, please. The important thing to recall here is that all funds committed should be risk capital, and that past performance is no guarantee of future results. Okay, a little bit about ourselves. We are AltaVest. Since 1997, 25 years now, we've been trading as a registered introducing brokerage firm. So 25 years, tens and tens of millions of contracts traded over the years. And we're in the futures and options industry, and that means we are highly regulated. Operations are audited at least yearly by different auditing agencies and government agencies and self-regulatory bodies and so on and so forth. So we're registered with the CFTC and also a member of the NFA. So like I said, for 25 years now, and we've been located here in California. And then the regulatory aspect of our business I think is important, and you'll see why in just a bit, but I'm sure you've seen some of the headlines this last week in particular about FTX, the crypto exchange. Of course, completely non-regulated, but maybe you've seen some of our presentations in the past, and hopefully you liked what you saw if you've seen them in the past, and maybe you're in for a little bit of a twist or something different this time around. A little bit about myself. I'm Erik Gebhard, been doing this about 30 years now. Started in 1991 with my Series 3 license for commodities and futures and options. I have my BS in Business Administration from the University of Southern California, so the Trojans. Actually just went to a game recently, so they're having a great football season. And I got my start in securities with mutual funds and insurance with my Series 6 and 63 licenses. And currently, of course, I'm licensed for commodities and futures. Also I have my Series 65, that's the investment advisor law exam as well. Okay, so we have some introductions out of the way. Let's jump into the 3 common barriers, and then we're going to jump into a demo here. But I want maybe some feedback, if you don't mind, on which ones that you might relate to the most in terms of these 3 barriers that I've identified in terms of successfully trading. Too much noise. I think that's kind of one way to summarize it here. Like social media, pundits, media. Well, here, social media says it's the most important, social media is the most important source of investment ideas for young investors. So that might be dangerous. I mean, these are the kind of people here on social media that are getting lots of hits, a lot of attention, and people are taking their advice for better or for worse, oftentimes for worse. Wall Street Journal says staying popular means you never criticize, especially a meme stock. So this is a lot of the advice here, folks, that you're getting out there on social media in particular. So you got to take everything with a grain of salt, to say the least. And all the hysteria and the hype and the hoopla during the pandemic with trading, everyone's at home bored and trading, and all that money, apparently, according here to Bloomberg, has been now lost, any money that was made. So that day trader army's broke. But what can you do? You want to follow pundits on TV? And yeah, I'll pick on Jim Cramer. I mean, he's well known. But here he says March of this year, the bear market's over. And of course, here's when he makes that call. And of course, we're not even remotely close to the bear market being over. September 11, he says, we've seen the lows in this tough market. Subsequently, dropped and crashed again. Predicts FedEx will have a great year. That was just here in June, and FedEx promptly dropped 50% here, it looks like. And even their CEO says we're entering a worldwide recession. And he talked about Meta, of course, that was a big favorite of his. And this is when he recommended Meta here and even here. And then it dropped 20% the following day, just recently, as you probably know. He got emotional a bit, said he did a bad job on Meta after previously recommending it. So the point isn't to beat up on someone. It's just to say that people that spend their waking hours studying this stuff are still having difficulty. There's even an ETF now, the inverse Kramer ETF. So just do the opposite of what he says, apparently is the purpose of this ETF. That's probably not a smart idea either. But following crypto personalities, you've read the headlines here, fully unregulated. These guys are operating out of the Bahamas, under the radar, so to speak, can do anything they want, get away with anything. I read that they said their books were audited in the metaverse. So, and they're serious about it. But anyway, it all went kaput. That's the CFO or CEO of the FTX Alameda trading firm. So that I just don't get it, folks. But apparently people trusted these people with billions and billions of dollars, and sophisticated investors too, not just retail investors like us. But here he is trying to act like he drives a Toyota, but here's, I guess, this penthouse he really lives in. Anyway, it was all a bit of a Ponzi scheme. And don't need to go into the details, but the point is that's all based on narratives and feelings and FOMO. You want to stay away from that. So that's really one of the big hurdles, right? Noise. But how about time? What about time? Not enough time in the day. Who has time to screen watch? Some people might, but remember, our most precious commodity is probably time. This guy here says I trade full time. I sit in front of my computer till the market open and the market closes, watching every once in a while after market hours. This guy says 10 to 12 hours in my day consumed by trading. And the point is to say that's all good and well if you have the time, but most of us probably want to do stuff like this, or this, or this, or the next one here is my favorite sometimes. Wouldn't we rather be doing this sometimes than struggling with trading and babysitting your trades? And even if you are screen watching, so to speak, are you beating the market? That's really the key. I mean, why bother? Are you efficient? Are you effective? Are you actually beating the market? According to this study, less than 1% of day traders are actually beating the market. Charles Schwab studied their most active accounts over a 6-year period, and those active accounts underperform a simple low-cost indexed fund. And here in Taiwan, they did a 15-year period study. Less than 1% were able to consistently beat the market. So you get the point. It's difficult, folks. And then I think another big hurdle is really a lack of a game plan or no professional guidance or even having the proper tools. I kind of lump that all together. And the problem with that is you end up with your emotions kind of running wild. So we think you need a little bit of professional coaching and guidance to control those emotions. So that's what we're going to help you with, hopefully here. I'll show you a demo and we're going to dig into that. But really, it can be expensive trying to convince the markets that you are right. And let's avoid this. You don't want to end up like this as you're 6 feet under. You don't want to argue with the prices, I guess is really what it says here. But emotions, we talked about that earlier this year. It says stock investors starting to feel the 5 stages of bear market grief. This is kind of a good summary: denial, anger, bargaining, depression, and then acceptance. And this is what that might look like on a graph. Slightly different wording and verbiage here, but you get the idea. Things are going great. You're really euphoric. We tend to think we're the smartest in the room, and then it all falls apart. Then you wave the white flag, capitulate, surrender. You get depressed, and then you're hopeful again, and you start that cycle. We want to jump off of that cycle, not even get on it. So how do you do that? Well, it turns out we can be our own worst enemies. I think we can all relate to that. And there's these 3 items here called confirmation, anchoring, and recency bias. We don't need to dig into all that, but really this one image here might summarize it. I think, like we kind of suggested, we tend to think we're a genius when things are going well. And that can really give you a false sense of security and be more harmful than anything, really. But really the big problem a lot of us face beyond everything I just talked about is the competition. The competition doesn't have all the pitfalls that we do. They don't have to screen watch and they don't have emotions because they're computers. Algos and machines are dominating the landscape. JP Morgan says 90% of US equity trading volume is algo driven. That's machine driven, prop trading, HFT, high frequency trading, institutions, running their machines and their models. So that's called revolutionary trading. I like this image here, so I like to keep that in. So here we are now in this robot phase, and here's how we were not too long ago. One of my visits down to New York. This is from years ago. Well, not too long ago, maybe 10 years. But that's what it used to look like, and now this is what it looks like. So this is our competition, no emotion, automation, built-in risk and reward controls. So we're going to jump into options now, and we're going to use the insurance company analogy. How would an insurance company, how does that relate to options trading? Well, keep in mind, insurance companies are paid premiums to assume risk. So they collect your money and they're selling and managing time to manage that risk, but they also insure themselves, they hedge themselves, and they're always consistent and patient in their process and their models, or at least they should be. And they use math, just simple probabilities, statistics, actuarials. And that's kind of similar to how you might operate if you're collecting option premium. Like an insurance company collects premium, we can also collect premiums by going short options. We need to be consistent and patient, manage risk. We will have losing trades. There's no doubt about that. And if someone says you're, going to win 99% of the time or whatever it is, run. So don't believe them. But anyway, manage reward. Don't get greedy. Proper tools are needed, of course. And again, we're looking at a baseball analogy here. Small base hits, not swinging for the grand slam. That's what collecting option premium is all about. So there are short option strategies for collecting premium, and they can be non-directional. If you're not familiar with that, I'll show you. And of course, bullish or bearish strategies. And all these outcomes are targeted with predetermined risk. So you can enter every position and know in advance what your maximum risk is at that moment. So these are called credit spreads. Every position is insured. We mentioned predetermined risk and reward, and then non-directional strategies, meaning if the markets are chopping around, there are still strategies we can employ in those environments. And we're going to talk about stock futures index options versus individual stock options. So I want to make that distinction. We are in the futures option space, not the stock option space. And there are some benefits to that, and I'll show you that a little bit later. But three of the kind of key benefits, in index, when you trade an index of options on indexes, they're less volatile. A large move might be, say, 3% in a day. Individual stocks, of course, can move, well, you could look at Meta down 20%, FedEx 50% in just one day. And of course, with options, you have strategies for all directions, so very flexible. And of course, you can apply hedging strategies or directional pure speculation if you'd like. And then if you're following an index, we can just track, that one index or maybe two indexes. We're not trying to filter through 6,000 or 7,000 securities. So that's why we like what we're doing. And again, these are futures options, and we're going to look at some strategies, and don't worry about this chart at the moment, but there are some advantages to that. And I'll show you in just a second. But before we dive in, let's look at the Greeks. We're going to look at two of them. When it comes to options, these are what we kind of suggest you have a familiarity with and nothing more. You can get into derivatives of and second order, as they call it, Greeks and Rho and Vega and all these things. But we're going to look at delta, and just very simply put, it's how much does the value of the option change with the underlying futures contract. And it's also the approximate probability of the option expiring in the money. So if the delta is 0.25, that means there's a 25% chance it expires in the money. Also, conversely, and this is how we look at it, there's a 75% chance it would expire worthless, and that's just math. And remember, delta is always moving up and down with price and time. It is not the probability of a winning trade. So keep that in mind. That's important. And then theta, here's the other Greek we're going to look at. That's just simply time decay. Remember, options always expire. They're what's called a wasting asset. And theta is a negative number that equals 1 day of time decay. So some of you might think, what the heck am I talking about? Here, very simply put, if an option's at 10 points and theta is negative 0.05, that means the next day, all things remaining equal in this illustration, the value of that option drops to 9.95. And the next day after that, it would drop to 9.90 and so on and so forth, just based on time decay, because you're running out of time. Every option expires. And that's what it looks like on a graph. As you approach time 0 and get closer to expiration, you'll see the percent of the premium remaining starts to drop and drop and drop, especially in the last, I guess you could say, depending on your time frame, the last bit of the lifespan of that option. Okay. Now, if you're only buying stock options, theta is working against you. So I think you're doing it wrong if you're only buying stock options. And there's a link here if you want to look this up. I found it on CNBC or YouTube. I can't remember, or YouTube, I guess. So I think this is an analyst, and she made some comments here and I happened to see, and I thought, well, better than I could say it, really. So here, let's take a look. The appeal for a lot of retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. So basically she's saying the chance of these trades working for you in the long run is very, very minimal. So that's why we trade spreads and use options that we sell, just like professionals do. And that's what we're going to talk about in this demo. So she says an option spread calls for buying and selling different contracts. It's a very common way for investors to hedge risk and volatility. And it's cheaper because you can offset your cost of buying an option by the proceeds from selling options, is really what she's saying. And it's been used by Wall Street professionals for decades. And in 2021, 11% of Robinhood active users made options trades, but of that, fewer than 1% actually made multi-leg options trades. So very unsophisticated crowd of options traders on something like Robinhood. Any options traders there, at least those that are trading options, are 99% of them are just only buying options. So we want to do what professionals do. We're going to look at multi-leg option strategies. For example, here's a selling a call spread. This red line here is the call that you sell, and you collect 4.5 points for that. You simultaneously buy that blue line, which is the higher strike price, and you pay 2.25. But the net result is you collect 2.25 points, or $112.50 in this example, minus your commission. So that's selling a call spread, and you hope the market basically stays below this threshold, that red line. Same thing with the put spread, just the opposite. You sell the red put there, you buy the blue one, and the net result is you collect $100 and put it in your pocket, minus your commissions, of course. Now, these are not naked options. Again, these are all insured or hedged. Your maximum risk is capped. These are called covered spreads. So no naked trading allowed, no naked creatures allowed. And here's a big benefit, huge, huge benefit, two of them. First of all, when you're covered, you have no margin calls. So the market's not trading you. You're not getting jerked around and throwing good money after bad. And of course, there's no unlimited risk. So very, very, couple key things to keep in mind. If you're trading naked options, don't. It may work for a time until it doesn't, and then you'll be done. So don't do it. I thought this was clever. This woman here is asking him, who is Margin and why does she keep calling you? So anyway, a little dark humor for margin calls there. Okay, iron condors. This is really the simultaneous combination of the spreads that we just saw, the put and the call spread. Selling out of the money call spread and put spread simultaneously, collect the premium on both sides of that trade, and then look for the market to stay in that range. Now here's the variation on a condor. It's our proprietary strategy. Some people have called it various things, but we like the word weird as a compliment. We'll take that as a compliment. It's called a dragonfly, something we came up with years ago. And it's a 6-legged trade. And again, a variation on the condor, and I'll walk you through it here. It looks complicated, but let me show you how it really isn't when you drill down. You sell 4 calls, buy 3 further out, and then 1 closer to the money. And you have the same structure with the puts. Sell 4 puts, you buy 3 further out, and then 1 closer to the money. And you'll notice, and we'll get into this in a second here, I'm ready to jump into the demo, but the put that you buy here and the call that you buy here, and I'll just stay with the puts not to confuse us too much, but you notice it's actually 50 points closer to the money compared to the 4 that you sold. So that will act totally differently, totally different risk and reward dynamic. And of course, the delta will be much higher compared to the 4 that you sold. And it changes the parameters and really the responsiveness of the trade quite a bit, and especially in certain circumstances. Of course, you can do lots of things with options, anything. We have a couple of strategies here. Instead of doing the full dragonfly, you could just do half by selling the call side, collecting the premium on that. And then something we call a bear hedge. You simply sell an out of the money call spread and you collect the money and you use that money to finance the purchase of an out of the money put spread. But here's the question. Are you confused like Jackie Chan? Because there's so many choices, let's say. If you're looking at your option chains and so forth, what expiration, what strikes, what's your entry timing, what's the value, what's your risk, how do you get out, on and on and on. So Theta Trader is our solution. These are pre-built option spreads. We have a proprietary algo that will curate theta trades on a daily basis. Advanced strategy, automation, and bull bear, flat market conditions, and then that automation for the risk and profit tracking, something called the risk thermal indicator, or the RTI. It's color coded, and we're going to demonstrate that. So let's jump into the demo. I need to switch screens here, so bear with me, folks, for just one moment. We got to choose from a few different monitors here, and I want to make sure. Yeah, and keep the comments and chats and everything coming, folks. So yeah, I can't get to it right away, but I do see them coming in, so please keep those coming. All right, now you should be seeing my page here for Theta Trader. This is the dashboard, and I guess if you don't see it, you'll let me know. But here we have the dashboard for Theta Trader, and we'll go through these menus in just a moment here, but this is a demo account I use for webinars. And you'll notice Theta Trades up here, open short positions, open bought positions or long positions, and then all of your account data here. This is all directly integrated with your AltaVest trading account. And then you see your current quotes here. So we'll just start at the top. You'll see there are bullish and bearish and non-directional strategies that you can choose from. And of course, these are all pre-populated, and I'll show you that in a second. But we're looking at 3 markets: the E-mini, S&P 500, NASDAQ 100, and Russell 2000. And I'll show you why we focus on these 3 a little bit later, but this is really the bread and butter of what we're doing. And we talked about condors and dragonflies. Let's take a look at what the algorithm has done for us today. It's generated these trades anywhere from 16 to 67 days till expiration. And you can hover your mouse over any one of them, and you see that pop up there that gives you the details on the trade. And you can see the strike prices are already pre-selected, the value of the position, and then the percentage. This is called the targeted annualized return at expiration. And what it does is it allows you to compare one trade to another. So don't expect to generate 229% a year by placing that trade. That's not the idea. It just compares one trade to another if you annualize it. I typically look at the longest dated trade. Let's drill down. Okay, so first thing I like to do, and I'll get into this in a moment, I look at a graph that gives you an overhead view. This is the call spread. This is the put spread. Here's the current market. And you can see some of the data here. We won't go through everything, but 67 days till expiration, the settlement value, the premium collected, put risk, call risk, commission, cash required. This is your profit potential at expiration. This is called your targeted return on cash and targeted annualized return that we looked at earlier. Now, notice the strike prices are pre-selected for you. And if you wanted to change them, you could, but that really defeats the purpose of the algo working for you. I want to point out here, you're selling the 3420 put. Now the delta is 9.73. We talked about delta. So that means there's over a 90% probability that this option would expire out of the money. And then let's look at the call. 6.62% delta. So you're looking at over 93% probability that this call would expire out of the money. So that's why the algo is choosing to sell it and collect the premium. And your maximum profit potential at expiration is here, and cash required is 883. And people will sometimes say, well, why are you putting up so much cash to make such a low amount of money in comparison? Well, again, you're flipping the whole option paradigm upside down. We're not an option buyer, we're an option seller here. And we talked about probability of these options expiring out of the money being 90%, 93% plus. So that's really the key here. Lots of base hits. And you'll see it pre-defaults here to a sell. You're selling the condor. Starts at a 1. If we want to do 3 of them, you see our cash required goes up or down. We'll just, we'll say 3 of these. And these are all net, by the way. All the percentages and figures are all net of commissions. Okay, so there you go. You can see we just got filled here because it's a demo account. So that's just that simple on how to place that order. And I'm going to show you in a second here how we track that. So we'll go back to the dashboard, and you'll notice here under trading, there's something called a trade simulator. And we're going to jump into that in just a second. But before I do, let's run into a dragonfly. We'll do this one, December end of month dragonfly. Yeah, I just see a question. Yeah, delta is not the probability of a winning trade. It doesn't mean you're going to win 90% of the time. It's just the probability that that option would expire out of the money. So yes, good comment there. And margin, just real quickly, again, margin is really, someone mentioned the word margin here. Cash required, that's the synonymous with margin for our purposes. But you can see that chart for the dragonfly here. And again, that same structure we talked about in the demo, and I'll show it to you right here, where you're selling 4 of these puts and 4 of these calls. And the deltas, again, are low. So that means there's a high probability that these options would expire out of the money. And that's why the algo is choosing to sell them. So you can see the cash required is 4,600, maximum profit potential at expiration, 353. And we always get out before expiration, and I'll show you why in just a minute. But you can see the dragonfly, of course, has a higher cash required amount compared to the condor, which we saw was about, what, 900, was it? And that's simply because you're selling in increments of 4 calls and 4 puts. And we'll go ahead and do 2 of these. We'll try to collect 8 3/4 on that. And just that simple. All right, so we're going to jump into this simulator here. And this is really, really unique. Let me show you here. I had some trades loaded here, and let me squeeze this down so you can see. Here we go. So you can go backwards in time and choose any date and go through any back test you want on these strategies. So we can use these buttons to go a day at a time forward or backward, or you can go right to the end, or you can just play it. But you can see here, this trade was placed with 60 days till expiration on March 1st of this year. And the green means good, do nothing, the RTI. And I'll show you the color coding in a second. But you can see it's a little bit negative at first, and that's normal because there's no theta decay working yet. But you can see it's now turning positive, green, RTI still green, and that's theta decay working for us. And then you get a blue, and that means take profits. And you can automate this. So that's really a key. The RTI is automated. Theta Trader will monitor and track your positions. And when it turns blue for a profit taking order, it will automatically submit that order for you. You do not have to screen watch. So that's kind of a typical condor that works out favorably. You know, market chops around, moves a little higher, which is fine, and doesn't matter. The condor is still profitable because of theta decay. And then let's see here. Now this was the April end of month condor, and I wanted to compare the April end of month dragonfly. So if you did a condor, you saw the result, and what if you did a dragonfly? Okay, so it had a profit taking order generated with 40 days till expiration. And note here that the condor had a profit taking order generated with 29 days till expiration. So you can see how in this example, the dragonfly matured more quickly than the condor. And that way you give yourself a chance to get out of that trade and take your money and move on to something else. So that's the benefit of the dragonfly at times. And there's some other benefits too. Okay, let's go back and run this one here. So here's a condor. Let's run this route. I forget what happened there all the way, but let's run it through. Okay, it turns yellow. That means elevated risk, but still do nothing. And then it turns orange, more elevated risk, but still do nothing. And then it turns red. Take your loss and get out. So that's a losing trade. And again, if it turns blue for a profit or red for a loss, that is automated for you. You can get out of that automatically. You don't have to screen watch. And we'll go back here and let's look at a dragonfly on that same day. So instead of doing the condor, you did this dragonfly. So you can see it's green, it turns yellow, a little bit of elevated risk. And then it turned blue, gave you a profit taking order. So instead of sitting through and waiting to absorb a loss on the condor, with this dragonfly on this day, this particular position here, gave you an opportunity to take profit. So that's why the dragonfly can be more robust at many times compared to the dragonfly. And it should make sense because again, you own this call and this put. And we'll look at a couple other simulations here. Here's a bear hedge. And don't worry about the colors on this one because it's actually inverted because you're actually long these. So again, the bear hedge, you sell this out of the money call spread up here, you collect the money and you buy an out of the money put spread. And of course, if the market drops like it did in this example and closes where it did, then you can see that it makes a nice profit there, of course. So that's kind of a bear hedge working favorably. And you can do half the dragonflies. Maybe if you're bearish, you can just do the call side of a dragonfly. And you can see it turned profitable way back here. Or you could just hang on to it longer if you wanted. It's up to you. But I won't go through the whole thing there. Our time is limited. And this is how you do it, folks. You go into my account and you go to settings. And that's where I am here. And you activate the risk manager. You activate the profit directive. And then you click save settings. And that's all you have to do to have the risk thermal indicator automate your management for you. So when it turns red or blue, whichever occurs first, you're going to be out of that trade. I also want to point out we have daily research here, something called TradeScope and our daily trading summary. And here's TradeScope, just an example. We run some analysis here every day. We give you an outlook and some guidance, forward-looking guidance here. And then we do something called the daily trading commentary, where we look for just a narrative on what happened in Asia and Europe and what to look for ahead, any technical support zones and economic calendar as well. It's a real nice user-friendly thing to use at a glance. And then also under this My Account menu, you have a great help file. You can see it here, and you can scroll down. And you can get a description of all the different spreads, all the acronyms, all the color coding here. So it's all here and available at your fingertips. And then also, these are all videos. So if you want a little extra tutorial with DataTrader, there's some videos here, and even educational videos on the option spreads that we're talking about if you're not fully versed, but it's all right there. So this is a great spot to keep in mind. So just going back real quickly, you can also look at any open positions on one page as well. Just a second here. So you can see here's some current open positions from just the demo accounts, but this is kind of what it looks like. Just kind of a mixture of orange and yellow and green, which is all fine. If you wanted to look at any particular trade, you just click on it. And that's pulling up the history on this trade, and you can look at a graph. So you can see that trade's highlighted in gray. So here it is from the beginning to where we are now. So with 65 days till expiration on October 13, this trade was placed. This condor and theta decay starting to work. And this is what it looks like here. And so, so far so good, nothing to do on it. You can also go back to your dashboard. You can look at your open trades, of course, right on the home page there. You don't have to look at everything all on this one page. Very convenient and user-friendly. Just look at everything on the dashboard. And then also, so yeah, you can see everything here and here. And you'll notice that, well, here, this is probably a better, I haven't looked at this in a while, but let's see what we get. These are closed positions from all the webinars I'm doing. As you can see, I just kind of randomly pick things, but you can see, yeah, well, this makes sense. You've got 20 trades on the page, and 15 of them were short positions, basically collecting premium, and 14 of those were winners. One was a loser. There were 5 bot trades, 3 were winners and 2 were losers. So that makes a lot of sense, sort of what we talked about when you're selling premium. You've got that higher probability there for you in terms of the option expiring out of the money. But anyway, there you go. That's what that looks like. Very simple, very user-friendly. And now I want to show you the best feature of all. And I think I'm right on target here. Yeah, I see some questions coming in, so keep them coming. I'll get to those. And again, I just want to point out, those were E-mini S&P 500, there's NASDAQ 100, there's Russell, and then the different trades, of course, depending on your outlook, they're all pre-populated and ready for you to choose. And then, of course, you can use that trade simulator here. You could even build your own trade from scratch if you wanted, but I don't think I know a lot of people don't do that, which is makes sense because that's the whole idea behind DataTrader is the algorithm does the work for you. And also, just to clarify too, everything is net of all commissions, and Altivest is we are Altivest, we are a brokerage firm, and DataTrader is our technology that we built and created for our own clients. It's our proprietary technology. So you would use DataTrader with an account at Altivest. So just like other firms have their own types of platforms, DataTrader is our platform. Okay. Let me jump back over. Now here's the best feature of all. And I don't say that lightly. I mean, I think it really is. And that's what we hear. And I think from the volume we get with people using it. So let me jump back to the demo. We're going to make your life even easier. Okay. Trade alerts. These are quite literally one-touch responsive trade alerts. You receive that alert, and all you have to do on your smart device is touch accept or reject, and our technology handles the rest. So these are live alerts, meaning they're integrated with your Altivest trading account. So you want that order placed, you like the alert, you just touch accept. It's ridiculous in this day and age where people are sending alerts with email and you have to log into another platform and then try to copy the alert and hope you don't make a mistake, do a buy sell error or something ridiculous. So this is going to make things so simple for you. Here's an example. You'll receive a text message, you'll touch it, takes you right to the alert page. See, it's a few years ago, but it's all working the same. So here's a condor, a description of the trade. You see a graph, and oh, what just happened? That was my problem there. So you can see here, this was a E-mini S&P 500 condor. Want to point out that it'll tell you the premium you're collecting, the cash required, and it's pre-sized. The quantity is already pre-selected for you. It's going to be customized and tailored for you and your account, and what other positions are in your account, and the account balance that you might be having, that you have in your account. So how about that? Makes it really, really simple. And you can see days till expiration. If you like it, you just touch accept, and that's all you do. So here, I'll give you one more walkthrough here. So people love the alerts. They absolutely love the alerts. And a lot of people just fully rely on those alerts. So that's an enormous advantage and feature for Theta Trader. So let's talk about getting you involved with the Theta Trader membership. I see more questions coming in. We'll see if we can get to those here. And oh, here we go. So Theta Trader software, to summarize, you get everything you saw, basically. The Theta trades, those are the pre-generated spreads. You get the risk thermal indicator with the automated risk and profit tracking. And then you have the trade simulator that we saw, all unique to Theta Trader and AltaVest. That software is valued at over $3,500. And then, of course, the trade alerts, we just saw that demo. These are actually incredible, very, very unique and convenient and effective. These alerts are live, meaning they're integrated with your trading account. So again, you touch accept and place that order. And then again, if you want to have the RTI automatically manage the trade for you, once it turns blue or red, you're going to be out of that position, whichever happens first. We do not hold things till expiration. I mean, very, very rarely, maybe there's some unique circumstance, but basically you're going to be out before expiration. So you have Theta Trader software, the alerts valued at over $8,000. And then of course you have us. We are real people. You get the private coaching to help you along the way if you need any questions answered or anything planned for your portfolio. So you have a co-pilot, and we're licensed, we're regulated, and we're experienced. So you get all of that, valued over $7,500, probably undervalued, really. So Theta Trader is the software with the alerts and the private coach, valued over $15,500. And then don't forget, we talked about our proprietary research. People actually really, really lean on this. They'll say, this is all I use. You've got the trade scope and your daily trading commentary. So that value there, $2,952. We talked about the online tutorials. Those are just embedded in the software. That's just part of the Theta Trader package as well. So you have the software, the alerts, the coaching, the research, over $18,500 value. And in the past, we've done these in live events in person, actually at $4,000 memberships. But we won't even do that, because we like these live events online, and we really, really appreciate Timing Research bringing us here. And I enjoy watching the other presenters too when I have time. But 80% off retail, limited time, $597, and this is just one payment. It's a lifetime membership. It's not quarterly, monthly, whatever. It's just one payment, $597. So here is your link, cf.altavest.com/TR. And that's my direct phone number. You can call me. And of course, I'm on right now with you here, but it'll go to someone else or voicemail. And take a screenshot of this. And here's the best part of all, right? The guarantee. So if you sign up, become a member, and something's not working for you the way you think you wanted it to, or your life changes and goes in a different direction, that's fine. We'll just refund it to you. No big deal. FAQs. Okay, tax efficiency. Let's get through this here. And yes, futures and options are tax efficient. So you can lower your combined tax rate by about 10% compared to trading individual stocks. So in this example, I won't go through the whole thing, but you'd have a rate of return of 12.6% if you're doing individual stocks. If you're trading futures options with us, your return jumps to 14.64%. You save taxes over $2,000 just because you're in a tax efficient space. So that makes a big, 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 big difference, folks. And there's no more itemizing. You just get a 1099 with your P&L for the year. That's simple, but always consult your tax attorney or advisor. And I see the link in there. Thank you for that. IRA, yes, there may be some other requirements, but contact us. But we have people transferring IRAs every day. So self-directed IRA, absolutely. And why the E-minis? They're liquid, they're efficient, and they're cost effective. And the E-mini S&P 500, I'll show you this right here. Compared to the SPY, it's 10 times larger in terms of the average daily dollar volume. And in terms of all ETFs around the world, take every ETF in the world, and the E-mini S&P 500 is still 2.5 times larger with the ADV there. So 5 additional reasons. We're going to get into that real quickly on why we trade these particular instruments. Volume, liquidity, and access. That means you get superior execution. The ES options offer a cost savings of $4 to $15 per contract compared to SPX. That means you get those tight bid offer spreads, large market share. You have all the strikes and expirations you need for granularity and coverage. So what that means is if you have some calls and puts here, and the algorithm is searching for another set of trades and more calls and more puts to sell, and more calls and more puts, with all that liquidity and volume, the algorithm is going to find what it needs and the strikes it needs and the expirations it needs. And here's a big thing too. You cannot do dragonflies with stock options. It can't be done as one order placed as one trade at one price. There's no legging in when you're doing a dragonfly with us, but you cannot do it with a stock option. It's just a totally different environment. You have to break up the order in two separate spreads. Very inefficient. Here's a comment on retail stock options traders. Remember, these are stock options traders she's talking about. Most retail stock investors only have access to the most basic call and put option strategies. So she's talking about the different levels based on your experience and income. And they don't have access to option spreads or other more sophisticated strategies. So with us, Theta Trader, you have immediate access to these sophisticated option strategies that we just talked about. These are the things that professionals are using. They're not just buying options and hoping for the best. That's not what they're doing. More advantages. How about just tracking the 2 or 3 indexes we talked about and not thousands of other markets? You have efficient margin versus stocks, and you have a clear cost structure. These are not securities options. These are all electronically traded. Your order is treated equally compared to everyone else's order. There's no payment for order flow. Your order doesn't get sold or any of that nonsense. And again, there's no such thing as free trading anyway with stock options. So that payment for order flow we talked about, that only applies to stock options. And she says here, most popular trading apps generate a lot of revenue from payment for order flow, and they make more money from stock options than regular stock trading. So there is an incentive for them to lure investors into trading stock options. They say they're commission free, but they're not. Orders were executed at prices inferior. They get fined. People are trying to save a penny, but they end up losing a nickel. David Einhorn says it's just disguised commissions, that payment for order flow, and nothing of value is truly free. So I don't want to hammer on that too much, but there's no payment for order flow with us. So our commissions are straightforward. They're competitive at 5.25 round turn all in. Again, that's round turn and that's all in. Here's a screenshot from a big box brokerage, and they say they're 2.25 for futures options, but that's per side. And then they don't show you that there are more fees, clearing and exchange fees and NFA fees on top of that. It ends up being higher than what we charge. So our rates are very competitive. Theta traders performance, people will ask, well, again, it's a platform for self-directed traders. So everyone has different results. Everyone makes their own decisions. And again, as a reminder, everything in Theta Trader is net of all trading costs. What size of account? Our minimum is 25,000, although we do suggest 50. Because if you want to do multiple dragonflies, each one's about 5,000. And people love this here. We'll give you a rebate on that membership fee. $100,000 or more account, you get 100% rebate, and 50% rebate if you have a $50,000 to $99,999 account. And of course, we can do, like I said, the IRA, individual, joint, corporate, LLC, trust. We get all these accounts every week. And just to kind of move, I've got some time here, so this is good timing. We can just kind of wrap it up with some more context. But why would you even consider these alternative strategies rather than just being passive and always bullish? Well, they may improve diversification and lower portfolio risk with having alternative strategies, such as what we just talked about. But what are you diversifying from? Well, how about inflation? Here's the value of consumer price index for consumers, purchasing power of the dollar. How about that? Down 40% in 12 years. Average hourly earnings have collapsed, of course, due to inflation is a big part of that. Services CPI at its highest since 1982. Just the other day, the Fed's Waller said we've got a long, long way to go to stop inflation. So they're going to be hiking for a long time. B of A says inflation can take until 2024 to fall back to 3% and then weigh on stocks. This is a good one here. People talking about a Fed pivot. They're not going to raising. Well, let me back up here. I'll just read it. Talks of a Fed pivot are not about the Fed going from raising rates to lowering rates. It's going from raising rates at a historic pace to raising rates at a near historic pace. Regardless, they are raising rates into a recession. 7.7% inflation is dangerously high. So that's a good summary. The Fed, we've never raised rates into a recession before, but they're forced to because inflation is so high. So we've got problems, folks. You need some different tools, some different approaches. You got, the yield curves at -54, I think, right now. It's a harbinger of a recession, if not already in a recession. Here we are here in that yield curve. So nasty, nasty stuff. 50% of CEOs say they're considering cutting jobs in the next 6 months. CEO confidence fell to a lowest since the 2008 recession. Meta laying off 11,000. They lost 700 billion. Amazon, Bezos is saying there's a recession looming. Prepare for the worst. He just cut 10,000. Amazon lost $1 trillion in market value. FedEx is furloughing drivers just ahead of the busiest season of the year. I mean, when does that happen? I mean, that says a lot. Jamie Dimon says it's going to be recession next 6 to 9 months. You've got all these firms, Twitter, Cameo, Robinhood, Intel, Snapchat, Coinbase, Opendoor, Stripe, Lyft, Shopify, Meta, Apple, Amazon, either laying off massive amounts or hiring freezes. Credit card debt soaring, record interest. So again, I don't want to be like the doom or gloomer, but this is all real stuff. This is happening. Consumer credit is maxed out. Personal savings are at lows. Credit card loans are at highs. Living paycheck to paycheck. Savings are plunging to levels. Auto loans, delinquencies, housing conditions here are at their worst for buying a house. Just about the worst. Higher, demand is collapsing. So anyway, on and on and on. I could go on and on, but I won't. There's one other thing I want to get to. Stanley Druckenmiller, you need to pay attention to him. Says a possible deeper recession than many expect. And says the rate hikes will continue here, the Chicago Fed president. But I wanted to say one last thing. You got to avoid those big drawdowns. I think alternatives can help you. So, it can take sometimes 6 years, 8 years, 6 years. Look at this, buying the Dow here. It took you until 1954 to get back to even. Or if you bought the Dow in 1966, you weren't back to even until 1982. So you want to avoid those drawdowns. Those can be pretty bad. High probability the stock market is flat for an entire decade, according to Druckenmiller. Pay attention to him, guys. The 60-40 portfolio, not helping you at all right now. Could be a lost decade. You could even end up with hyperinflation. So anyway, a lot of doom and gloom. That's why we love Theta Trader. Strategies kind of go anywhere, any environment you can apply these strategies to. So you have Theta Trader with the alerts, the personal coaching. Very simple to get your account open. Just follow the link there. And that's the last slide I've got. And hopefully I answered. I see a lot of questions that I did already answer. And I see the Canadian question. Sorry, we cannot work with Canadians. I wish we could. And if there's any other questions I didn't get to, let me know, but I think I'm out of time. And thanks for all the input, everyone. Hopefully you enjoyed it. Email me, Erik, ERIK, @altivest.com, and you can get me directly at the phone number as well. Do a screenshot on that, and it expires Friday night. I see that question. Yeah, Friday night. So you have some time to chat with us about it, and we'd love to hear from you. I love doing these presentations. So thanks again, and I think I'm out of time.